My name is Jonathan Goforth. Welcome back to my real estate channel. This video is to help you pass the real estate exam. Congratulations to you for studying to go take the exam and start the best career ever imaginable in real estate. This is a major section of material. We're going to talk about it first, and then, yes, we're going to do some test questions at the end of this. So we're going to talk about it first and help you understand all of it. And that way, no matter what test question is thrown at you on the real estate exam, you'll be able to answer it. But we're going to practice your recall with a few test questions at the very end. So yes, my name is Jonathan Goforth. I've been a full-time real estate agent for 26 years. Gosh, that's a long time. 26 years. I am with Keller Williams Platinum Partners, and I'm licensed in Missouri and Kansas, and I have my broker's license in the great state of Missouri. I say that because I have to identify the brokerage I'm with, as do you after you are licensed on any form of social media at all, any form of advertising, whether it's a flyer, a t-shirt, whatever it is you are advertising with, particularly social media, YouTube, Facebook, TikTok, you must always identify the brokerage you're with. Let's talk about legislation when it comes to lending, to financing. So you might be wondering, are there laws? What laws would there be when it comes to governing financing, interest rates, closing costs, things like that? The first one we're going to talk about are the usury laws. What are usury laws? I want you to screenshot a lot of this. In particular, this is when you need to know what a usury law is. The usury laws, first, they vary from state to state. But the purpose of the usury laws is to set the maximum interest rate that a lender can charge. That's all they're there for. They set the maximum interest rate that a lender can charge, and they vary from state to state. The purpose of the usury laws is to prevent predatory lending, to prevent interest rates that gouge a buyer, that take advantage of a buyer's situation. And that's what usury laws are. Make sure you screenshot this. You might see this again in just a few minutes when we practice some test questions. We're going to talk about something so important. I want you to screenshot everything that we're going to talk about. I'm going to try to go over the hot points, the most important things to this material, and then we're going to do more studying at the end when we go through. I think I have 4 different questions at the end we're going to go over regarding this. So let's talk about the Truth in Lending Act. It's abbreviated as TILA, Truth in Lending Act. So when you see TILA, you've got to remember that's what TILA stands for, is the Truth in Lending Act. It's also called Regulation Z, and you will see both. You're going to see that interchangeably used. So when you see Regulation Z, that is TILA. That's the Truth in Lending Act. This got established in the late 1960s, I think 1968 or 1969. Right in there is when the Truth in Lending Act came out. And the purpose, what it does, it makes sure that lenders are required to disclose their costs, their fees, and the interest rates to the buyer, to the borrower, to the consumer. And there's a lot more to it than that, but you've got to just memorize that right there. So when you see TILA, Truth in Lending, Regulation Z, that's what it is. It's the requirement of lenders to disclose the costs, the fees, the interest rate, everything regarding that to take out a loan. And they have to do it before closing. And there's deadlines and timing involved in these things. But that's what it is. Now, Truth in Lending Act, it governs residential properties from 1 unit up to 4 units. So a single family house, a duplex, a triplex, a fourplex, all fall under the Truth in Lending Act. But if it's 5 or more units, maybe it becomes a small apartment building, something like that, then the Truth in Lending Act does not govern 5 or more properties. You might see a question on that, maybe not, but it's something, just to toss that out there so you know this governs 1 to 4 units of properties. A couple other things I want you to remember. If a lender discloses one of the credit terms, they have to disclose all of the credit terms. That falls under the advertising that they have to do. So if a lender starts disclosing one thing, they have to disclose all of the terms. So something else I want you to remember, we're going to talk about this in just a second. There's a difference, a big difference between the interest rate and the annual percentage rate. You need to know that as a real estate agent. There is a big difference between the interest rate. So when you hear, well, interest rates are 6% today. Your buyer says, well, I think interest rates are about 6%. They're seeing that wherever, maybe online somewhere. Maybe they've asked a lender how much are rates today, and they're saying 6%. That is not the annual percentage rate. We're going to talk about that in just a second. If a lender discloses an interest rate, they also must disclose the annual percentage rate too. Let's talk about the differences between those, because this sounds like it could be a test question. Please subscribe. Before we go any farther, subscribe, give this video a like. I need a thumbs up, please. I'm going to give you a little explanation. We're about to talk about interest rates and the difference between the interest rate and the APR, the annual percentage rate. But first, I want to talk about a 3-day right of rescission and how that plays into this with somebody taking out a loan. What is that right of rescission, that 3-day period? So let's say you are going to be a real estate agent. You are selling properties. The buyer is taking out a first mortgage. So at your closing, there's a loan package. They are taking out a first mortgage. And there is no right of rescission. When they sign closing papers, that's it. There is no backing out when they leave the closing. But let's say it's a second loan, a line of credit. It's a home equity loan. It's something in addition that comes along later after their first loan. And on those loans, yes, there is a 3-day right of rescission. They can back out within 3 days after they close on that loan. And I tell you this because, first, there is no right of rescission on the first loan. And we're talking about first loans because you're studying to become a real estate agent. Your buyers are taking out a first loan. But let's say along the way, they want to take out a second loan. Your buyers might think when they sign those papers, they want, how fast do I get my money? How fast do I get that? I got to go shopping. I'm taking out this home equity loan to go buy a boat or whatever. They really should be using it to invest in their home, but whatever reason, they're taking out a home equity loan. A lot of these buyers think, oh, I'm going to get that money later today, tomorrow morning at the latest. No, they are not. Their 3-day period has to pass because they have the right to walk away for 3 days after that signing. Those right of rescissions, that's what I want you to remember. It is not applied to these first loans, only for additional loans, lines of credit later. Now, that's just a freebie. Please subscribe. After you pass your real estate exam and you get licensed in your state, come back because all my other videos are about how to make you a lot of money in real estate. I've been doing this 26 years. Last year, my team and I have a real estate team, the Go Forth team. We were paid, I'm proud of this. I don't say this to brag, but we were paid over $1 million last year in commission, just my team and I. The year before that, we were paid over $1 million. I love this career. It is by far the best career possible. Truly unlimited income potential. There are no other careers that offer something like this. Let's talk about the difference because there is a huge difference and you need to know what we're talking about. Interest rates are usually what you think about when you see, oh, the interest rate is 6%. And that's what the interest rate is, 6%. However, that is just the rate. So if a lender for this material is disclosing an interest rate, they also have to disclose the APR. So when you see an APR on anything, that stands for the annual percentage rate. That's the APR. The APR is typically going to be more. It's going to be a higher rate. Here's how this works. So in this example, the interest rate by itself is 6%. Let's say the buyer's taking out a $100,000 loan. 6% of that is $6,000 in interest. Pretty simple. That's the interest rate. 6% is $6,000 in interest. However, remember, with the Truth in Lending Act, the lender must disclose all the costs, all the fees, and so the annual percentage rate is the total loan costs. So in this case, we have the $6,000 in interest, plus this lender has a $1,000 origination fee, and this lender is charging $3,000 in points, plus the interest, because it's 6% interest rate. That comes up to $10,000 in total loan costs. All the fees that create this loan, which is now 10% of the $100,000 loan. So the interest rate is 6%, but the APR, the annual percentage rate, is 10%. And it's that simple. It's just that simple. You need to know the difference. The annual percentage rate is the total loan cost. That's what I want you to remember. Just remember that. The APR, when you see APR is, boy, I butchered that P, didn't I? The APR is the total loan cost, the interest rate plus the other costs. I have a feeling you possibly might see this concept on your real estate exam. These questions are good for all 50 states, by the way. It doesn't matter where you live in the country. This is fair game for you. Doesn't matter where you live. This is good, generic, national material. And you should know this anyway. So when you see APR and you wonder, that's not the interest rate. Well, it's because it's got the total loan costs included in it. See? And you'll see that on cars. You'll see that on homes. At closing, your buyer will see both. They're going to see both the interest rate and they're going to see the APR. And that's why it's required to be disclosed through the Truth in Lending Act with Regulation Z. Remember, that's what TILA stands for. All right, let's move right along. We're going to talk about RESPA. There are 5 items required by RESPA. This is good stuff. This is stuff that test questions are made of. You've got to know this. Screenshot all of it. Go back and watch this again. This is one of those videos that I want to make sure you really do understand. RESPA stands for the Real Estate Settlements Procedures Act. Memorize what it is. Now, what is the purpose of RESPA? Remember, there's 5 components to RESPA. We're going to talk about all 5. The purpose of the Real Estate Settlement Procedures Act is to inform buyers of total closing costs. That's a big component of this video because we're talking about legislation that deals with lending. That's the purpose of this video for this subject matter. So now there's 5 components of RESPA, but the main purpose for this video is to inform buyers of their total closing costs. HUD oversees it. So if you get a question, who oversees RESPA? Well, it's the Department of HUD. It only applies to 25 acres or less. It applies to all first mortgages. And again, we just talked about this, from single family, 1 property, up to 4plexes. So a single family or 2 properties, a duplex. A triplex would be, 3 units combined, or a 4plex. When we get 5 units and higher, RESPA does not apply anymore. But let's talk about the 5 requirements that fall under RESPA. So remember, there are 5 items required by RESPA. Let's talk about the first 2. There is a home loan toolkit. Yes, you want to screenshot this one. A home loan toolkit. This explains the cost to close and it's provided within 3 business days of the buyer making loan application. So the buyer makes a loan application, and then the lender is going to send them a home loan toolkit, and that explains the cost to close. And they have to send it to the buyer within 3 days of the loan application. Number 2 is the loan estimate. It's also required by RESPA. It's an estimate of the total closing costs, and it is also to be provided within 3 business days of the buyer making loan application. So remember, our first one was the home loan toolkit. Number 2 was the loan estimate. Those both have to be provided within 3 days of the buyer first making the loan application. Number 3 is the closing disclosure. This one affects you more as the real estate agent. I'm going to tell you why this will, because I'm a real estate agent also. Let's talk about how this one affects you to make this practical. The closing disclosure, again, it's required by RESPA that a lender do this. It's to be provided within 3 days before closing. So right before closing, now we're 3 days before closing, the lender provides this. It has the actual closing costs. This is the real one. This is what the buyer will see at closing. They're going to sign the CD. You're going to hear this also called a CD by the title company or whoever's doing your closing. Could be in an attorney's office or something. That's the closing disclosure. Now, if a closing date is changed, which you're going to know that first, as the realtor, you'll be doing an amendment to do a extension of the closing date, or you're going to scoot it up faster. My gosh, if you scoot it up faster, make sure the lender knows. This is part of why you should subscribe, because this is the practical side of this. If you're going to scoot your closing up sooner, which does happen, the lender, required by RESPA, must notify your buyer within those 3 days before closing. If it's the day before closing and they didn't do this, you are not closing. That's happened. So 3 days before closing, it could be farther back than that. Sometimes it's 4 days before closing, but it cannot be 1 day before closing or 2 days before closing to provide this closing disclosure. So if you're going to scoot closing up sooner, tell your lender. Make sure they get the CD prepared and sent to your buyer. It has got to be provided to your buyer 3 days before closing. If the closing date is changed, you're scooting it up or you're extending it out farther, the prorated items need to be adjusted. Your closing company, the title company or whoever's doing the closing, they will do that for you. But if you change that closing date, make sure your lender knows. Make sure your buyer's good with this. They might have already taken off work for the real closing date. So if you change that, get everybody on board. That is part of your responsibility because you're probably the only one that knows the date is changing. And things that will be adjusted, things that get prorated, just so you know, taxes, property taxes, they are prorated to the day of closing. If that property is in a homeowners association, that is also adjusted. That's prorated out to the day of closing. So if your closing date changes, the prorated items need to be adjusted also. From the practical side of this, so on my closings, for my buyers, I check in with their lender leading up to that 4 days, 5 days, 6 days before closing, like just making sure we're good for closing. I just, not that I'm a micromanager, but I've been busted on this too many times. The lender forgets to send the closing disclosure. My gosh, they forget. That means you are not going to close on time. Whenever they send the CD, you're waiting 3 days to close. So, and every once in a while, the lender, say it's in the springtime and it's busy, the lender is overwhelmed and they forget. Or they think it got sent by one of their loan assistants, make sure you get that CD sent out to so-and-so. Well, they forgot. Well, they didn't check. And so you are not going to close on time. That's a big deal right here. So yes, I do remind the lenders, did you send the CD? And I do this 4 days before, 5 days before. I give them a little heads up. Hey, we're closing in 5 or 6 days. Make sure you send the CD. I don't want any issues leading up to closing. All right, let's do numbers 4 and 5. Number 4 are the prepaid items and the limits that RESPA is requiring the lender to comply with. And let's talk about what this is. This doesn't really affect you as a realtor. There's nothing you have to do, but you're going to see it at your closings. So I'm going to explain what this is. This will help you understand it so you get this test question right. On the CD, on the settlement or the closing disclosure, also called the settlement statement, the lender is going to be escrowing for taxes and insurance, probably. And so you're going to see a line item. Here's how much is being collected for the insurance for that year. But the following year, chances are, the cost of the insurance is going to go up when it comes up for renewal. The lender knows that, and so they want to collect some extra. So it's a overage. They're going to collect a few months of extra insurance. The same with the taxes. Taxes pretty much don't go down. It's probably going to go up. Next time it's up for reassessment, and so they're going to collect some overage for taxes too. So when the tax bill comes out again, there's enough extra money sitting in that escrow account to pay them without there being a shortage. And so RESPA says to the lender, you can't just collect as much money as you want. You can't just put thousands of dollars of the buyer's money in that escrow account. That's not going to be allowed. So RESPA places a limit on how much money the lender can collect and hold in that escrow account. And so you're going to see an aggregate adjustment on the CD at closing. When you review your CD, you're going to see taxes and insurance amounts on there they're collecting that the buyer pays. And then you're going to see a minus, the subtraction of the aggregate adjustment, which enforces the limit. And it's a formula. It's just a formula. The lenders know how to do this. And so that's what that is. And this limit, based on the prepaid items, falls under one of these 5 things of RESPA. Number 5, there are no kickbacks. You cannot receive a kickback from anyone for anything, for any reason, for any amount, period. The answer is no. The answer is just simply no. There are no kickbacks. RESPA prohibits kickbacks. Now, later on, as you become a real estate agent, you'll remember this because this is one that's stressed frequently later with continuing education. You may not receive a kickback from a lender, from a title company, from anyone. They are not allowed to pay you for the business you give them. That is a kickback. It's illegal. It's a crime. It's required by RESPA that you will not receive a kickback. Period. That's our 5 things. Now, going to cover a couple other things that you just might see on this exam. Let's do those now. So I'm going to give a little bit of advice. We're about done with the material. This is the end. Then we're going to do some test questions. We're going to practice because this is one of those videos you need to know this. Here's how this works. So I've got my broker's license in Missouri, and I'm licensed in Kansas and Missouri, 2 states I have real estate licenses. Here's how it works when you go take a real estate exam. And I'm just going to give you my advice. We are not studying for the fun of just learning everything about real estate. You are studying to go pass an exam. And so let's talk about some advice on how you do that. First piece of advice, I want you to relax because you don't have to get all of them correct. You just need enough to pass. Here's how a test question is designed, and you're going to see that in a moment. Put yourself in the position of the real estate commission, the people who write these questions. You know, they think of a question like, yeah, it seems like a pretty good question. And so they're going to give you 4 options, 4 choices, answer choices. One of them's correct. They've got to make up 3 wrong answers. They're going to try to stump you a little bit. It's not just learning This is what I want you to learn. Here's the name of it. Here's the abbreviation, and here's what it is, the description of what it is. Another one, here it is, what it abbreviates as, and here's what it is. Because you may see these used as the wrong answers. And so if you know what this is, then you can eliminate it when you see it used on a question as an answer. You think, no, it's not that. I know CFPB is the Consumer Financial Protection Bureau, and I know it protects against unfair, discriminatory, abusive practices in financing. And when you see that, and that's not what the question's asking for, you can eliminate it. Think, aha, I know that's not the correct answer. That's how I want you to think in your mind as you go into this exam. That's how good I want you to know this. So I want you to study like crazy. I've got a whole bunch of other test question videos. I want you to go through all of them. Go through other YouTube channels. Go through as many practice questions as you can to learn, and go take the exam. Go take it quickly. While all this is in your head, go take it quickly. Chances are you're going to pass because you've been studying. If you do not pass the first time, then schedule it again as fast as you can. Don't let too much time pass. Study like crazy again and go take it again. Maybe you're just having an off day. But get this over with quickly so you can begin your real estate career. Let's talk about what these two things are, and we're going to practice with some questions. The first one, the Consumer Financial Protection Bureau. Screenshot this. The abbreviated as CFPB. I want you to remember when you just think of CFPB, oh, I know, the Consumer Financial Protection Bureau. Now, I know this is kind of hard. You're just memorizing stuff. What is it? The CFPB, it protects against unfair, discriminatory, abusive practices in financing. The other one is the Equal Credit Opportunity Act. Chances are you're going to see this on the exam, ECOA. Please memorize this bottom one. If there was ever a reason to give my video a like, memorize that. The Equal Credit Opportunity Act, ECOA. What is it? It bans credit discrimination. It bans credit discrimination of race, color, religion, national origin, sex, age, marital status. That's what it does. It bans credit discrimination. And yes, you need to know the list of things because they may toss you an extra thing that is not something that it's banning. So remember, it bans, in case you're driving around and not watching your phone, I'm going to read it again. The Equal Credit Opportunity Act, the ECOA. It bans credit discrimination of race, color, religion, national origin, sex, age, and marital status. Now, something I want you to remember is this bottom one. You cannot refuse credit. A lender cannot refuse credit based on public assistance income. If somebody's getting public assistance as part of their income, a lender cannot refuse credit. They cannot discriminate against that. That would be food stamps or child support. Any form of public assistance income cannot be discriminated against. You might want to remember that one too. This comes to you from many wonderful people who have taken the exam in the past. And so let's end the material for this. Hopefully you don't have a headache, but let's practice now. Let's just take a moment and let's do some learning with some questions that you could see something very similar to this. Thanks so much for watching. Please do subscribe. I'm honored when you subscribe, and please give this video a like. And you know what would make me feel good? After you pass the exam, come back and put a comment on one of my test question videos. Say, I passed, because that motivates other people who are going through the same thing that you're going through now of all this studying. This takes all of the cost of borrowing as a percentage. Number one, the interest rate. Number two, annual percentage rate. Number 3, amortization rate. Number 4, the RESPA rate. So look at that question. This takes all of the costs of borrowing as a percentage. And that'd be number 2. Your answer is number 2, the APR, the annual percentage rate, because it's asking for all the costs. So it's taking in the interest rate plus the other costs as a percentage. And that's a great test question right there. These are state-specific laws that set forth limits for interest rates in specific types of lending instruments to prevent lenders from imposing unreasonable or predatory interest rates. Number 1, Regulation Z. Number 2, the Federal National Mortgage Association. Number 3, usury laws. Or number 4, RESPA. So we've already covered this in this video. You know it's not number 1. We've covered what Regulation Z is. You know it's not number 4 because we just talked all about RESPA. What is number 2? The Federal National Mortgage Association. We didn't talk about that on this video, but let's talk about it now because you need to know what number 2 is. The Federal National Mortgage Association, that is FNMA. That's what it's abbreviated as, and that we call Fannie Mae. So what is Fannie Mae? What does Fannie Mae do? Fannie Mae, it buys notes, it buys loans from lenders to provide liquidity. It's privately owned, but it's government sponsored. And it's not the answer to this question. That'd be a wrong answer. But that's what Fannie Mae is, in case you need a refresher on that. Your answer to this is number 3. Those are the usury laws. Those are state-specific laws that set forth limits for interest rates in specific types of lending instruments to prevent lenders from imposing unreasonable or predatory interest rates. So your answer is number 3, usury laws. Which of the following would be outside the scope of what a lender can do under the Equal Credit Opportunity Act? Remember the ECOA. So again, let's read it together again. We did not exactly cover this on this video, so we're going to teach it now. Which of the following would be outside the scope of what a lender can do under the Equal Credit Opportunity Act? Number 1, give specific reasons why the credit was denied. Number 2, discriminate against a borrower who is receiving income from public assistance. Number 3, inform an applicant within 30 days of a denial or the granting of credit. Number 4, verify a borrower's income sources. So you probably remember just from a moment ago, we did talk about number 2, and that's your answer. Which of the following would be outside the scope of what a lender can do under the ECOA? They cannot discriminate against a borrower who is receiving income from public assistance. They cannot do that. So they can do the other 3. So that would be a good one to screenshot. They can do number 1, 3, and 4. And that's a great test question, by the way. That is a great test question. That would be something to screenshot, kind of review that one. Next question. Which of the following must be disclosed to a buyer when taking out a new first mortgage under the federal truth in lending law? Number 1, all encumbrances. Number 2, a copy of the Sherman Antitrust Law. Number 3, the APR, the annual percentage rate. Or number 4, the total amount of interest paid over the life of the loan. And your answer is number 3, the APR, the annual percentage rate. Let's review that before we get off this question, and then you're going to see a couple of slides popping up that you can click on. Those are there for you to click on more links, more of my videos to give you more test questions to practice with. Let's read this one more time. Which of the following must be disclosed to a buyer when taking out a new first mortgage under the federal truth in lending law? And what must be disclosed? The APR, the annual percentage rate, that must be disclosed under the federal truth in lending law. Thanks so much for watching. Please give this a like because it just makes me feel good. And please subscribe if you have not already. Click the word subscribe. Turn on that bell icon next to the word subscribe so you get notified of future videos. And now check out some others. Keep studying. Click on one of the screens that's popped up in front of you. And thanks so much. See you on the next video.